Your house. Everyone says buying a house builds wealth and equity, but for most people, their home is actually a massive money drain disguised as an investment. Here's the reality. Your house doesn't generate income. It only costs money. Every month, you're paying the mortgage, property taxes, insurance, maintenance, and repairs. The average homeowner spends about 3 to 4% of their home's value annually just on upkeep. On a $300,000 house, that's $9,000 to $12,000 per year before you even touch the mortgage payment. Then there's the opportunity cost of your down payment. Let's say you put $60,000 down on that $300,000 house. If you had invested that money in index funds earning 8% annually, it would grow to about $130,000 over 10 years. Meanwhile, your house might appreciate 3% per year, but after all the costs of ownership, your real return is often close to zero. Houses also trap your wealth. You can't sell part of your house when you need money. If you want to access your equity, you have to take out a loan against it, which means more monthly payments. Or you have to sell the entire house, which takes months and costs 6 to 8% in fees and commissions. The biggest problem is that people put too much of their wealth into one asset. If 80% of your net worth is tied up in your house, you're not diversified. If the local housing market crashes or you lose your job and can't make payments, you could lose everything. Many people would actually build more wealth by renting a modest place and investing the difference between rent and total homeownership costs in the stock market. But nobody wants to hear that because we've been told homeownership is the path to wealth. Your car. Most people need a car, so they convince themselves it's an asset. After all, it has value and you can sell it, right? Wrong. Your car is one of the worst financial decisions you make, and it's costing you way more than you think. Cars lose value faster than almost anything else you can buy. A new car loses 20% of its value the moment you drive it off the lot. After 1 year, it's worth 70 to 80% of what you paid. After 5 years, most cars are worth less than half their original price. But depreciation is just the beginning. The average American spends about $9,000 per year on car-related expenses. That includes payments, insurance, gas, maintenance, and repairs. Over 10 years, you're looking at $90,000 for something that will be worth maybe $5,000 at the end. Here's what really hurts. Most people finance their cars. They take out 5, 6, or even 7-year loans to afford newer, more expensive vehicles. This means they're making payments on something that's losing value every month. You end up owing more than the car is worth for years. The smart move is buying reliable used cars with cash and driving them until they die. A good used car can serve you just as well as a new one, but it won't destroy your wealth in the process. That $400 monthly car payment, invested at 7% over 30 years, becomes about $400,000. Timeshares. Timeshares are sold as real estate investments that pay for themselves through vacation savings. They're actually one of the worst purchases you can make. Most timeshares lose 80 to 90% of their value immediately and come with ever-increasing fees you can never escape. When you buy a timeshare, you're not really buying real estate. You're buying the right to use a property for a specific week each year, and you're paying resort prices for that right. A $25,000 timeshare might cost you 1 week per year at a resort, but you could stay at that same resort as a regular guest for much less money. The maintenance fees are the real killer. These start around $500 to $800 per year, but increase every year, often faster than inflation. Over 20 years, you might pay $20,000 in maintenance fees on top of your original $25,000 purchase. That's $45,000 for 20 weeks of vacation. Try to sell your timeshare, and you'll discover they're almost worthless on the resale market. Most sell for 10 to 20% of the original price, if you can find a buyer at all. Many people end up paying companies thousands of dollars just to take the timeshare off their hands. The vacation flexibility isn't real either. You're locked into specific weeks at specific locations. Want to go somewhere different? You have to trade through exchange companies that charge fees and rarely give you the dates or locations you actually want. That $25,000 timeshare plus maintenance fees over 20 years could total $50,000. Invested at 7% returns, that money becomes about $140,000. You could take incredible vacations every year with just the investment returns and still have the principal growing. Whole life insurance. Whole life insurance is sold as both protection and investment, but it's actually a terrible way to build wealth. Insurance salespeople love whole life policies because they pay huge commissions, but they're almost always a bad deal for the buyer. The investment portion of whole life insurance typically returns 2 to 4% per year, which barely keeps up with inflation. Meanwhile, you could invest the same money in index funds and earn 8 to 10% annually over the long term. The difference is enormous over time. Here's how the math works. A 30-year-old might pay $300 per month for a whole life policy. That same person could buy a term life insurance policy for $30 per month and invest the $270 difference. After 30 years, the whole life policy might have $150,000 in cash value. The term insurance plus investing approach would have about $650,000. Whole life policies also have terrible liquidity. If you need money from your policy, you have to borrow against it and pay interest on your own money. If you surrender the policy early, you lose most of what you've paid in due to surrender charges. The insurance industry has convinced people that whole life is forced savings for people who can't save on their own. But if you can't discipline yourself to save and invest regularly, you probably can't afford the high premiums of whole life insurance either. Buy cheap term life insurance for protection and invest the difference in low-cost index funds. Your family gets the same protection and you build real wealth through actual investments. 401k loans. Your 401k isn't keeping you poor, but borrowing from it definitely is. When you take a loan against your 401k, you're robbing your future self to pay for things you want today. It seems harmless because you're paying yourself back, but the math tells a different story. When you borrow from your 401k, that money stops burning investment returns. If the stock market goes up 10% that year, but you borrowed $20,000, you missed out on $2,000 in gains. You're paying yourself back with after-tax dollars, but you'll pay taxes again when you withdraw in retirement. The biggest risk is job loss. If you lose your job or change employers, most 401k loans become due immediately. If you can't pay it back, it becomes a withdrawal with penalties and taxes. A $20,000 loan could cost you $7,000 to $8,000 in taxes and penalties if you can't repay it. Even worse, while you're paying back the loan, you're often contributing less to your 401k because you can't afford both the loan payment and regular contributions. This means you're missing out on company matching and compound growth during your peak earning years. People justify 401k loans by saying they're paying themselves interest instead of a bank. But you're not really paying yourself. You're paying back money that should have been growing in the market. The interest you pay yourself doesn't come close to making up for lost investment returns. If you need money, exhaust other options first. Personal loans, home equity lines, or even credit cards might be better than stealing from your retirement, depending on the situation. Savings accounts. Most people think savings accounts are safe assets that preserve wealth, but they're actually making you poorer every year through inflation. When your money earns 0.5% interest, but inflation runs 3 to 4%, you're losing 2.5 to 3.5% of purchasing power annually. Banks love savings accounts because they get to lend your money at much higher rates while paying you almost nothing. They're using your money to make profits while your wealth slowly erodes due to inflation. The safety of savings accounts is an illusion for long-term wealth building. Yes, you won't lose principal, but you're guaranteed to lose purchasing power over time. Money sitting in savings for 20 years will buy significantly less than it does today. People keep too much money in savings because they're afraid of market volatility, but the stock market has never lost money over any 20-year period in history. The risk of investing is actually much lower than the guaranteed wealth destruction of keeping everything in savings. Emergency funds should be in savings accounts. You need 3 to 6 months of expenses in cash for unexpected situations. But any money beyond your emergency fund that's sitting in savings is slowly making you poorer. A $50,000 savings account earning 0.5% becomes about $55,000 after 10 years. But inflation at 3% means you need $67,000 to buy what $50,000 buys today. You've actually lost $12,000 in purchasing power while thinking you were being safe. That same $50,000 invested in index funds at 8% returns becomes about $108,000 after 10 years. Even accounting for inflation, you've more than doubled your purchasing power instead of losing it. Did you enjoy this breakdown? Then please subscribe and hit that bell button.